Well, we highlighted that big sell-off for stocks as we start a new trading week. Let's go to the trading floor in Chicago. Alan Nuckman is a chief market strategist at Agora Financial. Alan, we mentioned these are not days that we're used to over the last year because it's a market that has been melting higher. What's going on the trading floor this morning?
Well, good Monday morning to you. So we're seeing some price action. Now, you talked about it correctly in that open there, that it's all about percentages. I mean, we're down 1.5%, not to minimize what's happening, but, you know, we've been waiting patiently, waiting for this market to pull back, wanted to see some profit taking. And for a trader, it's important to see how it reacts now that we've had some action on the downside. So this is a bit of a pullback, but in percentage terms, this is not a big deal as it stands right now. I'm focusing on 3,200 in the S&P on a weekly basis. That's an important super support point. That was from the range that we traded in for the longest time between 2,800 and 3,000 from, I think, May till October. So let's see if that 3,200 can hold on a weekly basis. And you've got to remember that volatility is opportunity. People have been begging for these stocks to sell off so they could step up. Now let's see if they actually do it.
All right, so just to do some quick math there, when we're showing the S&P chart today with this sell-off, 3,200 as a support level, if we're at 3,244 right now, would be
on a weekly basis.
On a weekly basis, but that'd be basically 1 to 1.5% below where we are. So you wouldn't be surprised to see a little more selling pressure, basically, is what you're saying.
Right, and I want to see how the markets react when we get to a specific market floor, because that's a very important technical number to keep an eye on. Again, on a weekly basis, we can violate things anytime intraday and bounce around and shake the tree, and I expect these things to happen. But if you look at volatility, because that's what we're talking about right now, we're looking at the VIX right now is, what, at 18, maybe 19? Still below the 20 level. Let's remember back in October where this whole thing started from. The S&P has gone up more than 10% straight up since October. That was the last time the VIX was at 20, and the price was below 3,000. So, you know, again, I think a lot of this is more psychological. As it stands right now, you know, we're not in any, you know, catastrophic situation. I look at this as profit-taking, and last week we had a weekly key reversal where we saw new all-time highs on a weekly basis and a lower weekly close. So that brought to the end, I don't remember how many weeks of straight-up stocks that we've seen, but that brought that to the end. Now it's important to see how we react in the next coming days.
All right, let's compare what's going on today to what happened at the start of the year. Like, we didn't anticipate major tensions between the U.S. Iran in the same way that we didn't anticipate a virus coming out of China and potentially crippling the economy for a period of time. In the case of those U.S.-Iran geopolitical tensions,
short-lived.
It was short-lived.
It was a couple days.
So what would
that was it.
So what would you be watching for? Like, what would be, if we're watching a story like the coronavirus, what are the things you're looking for, listening for, that might determine the direction of the markets?
I'm nothing but a price guy.
Okay.
The news is, you know, to me, I'm going to focus on how the markets react. And, you know, let's see if we test that 3,200 and how we behave. Again, we're down 1.5% today. So in percentage terms, this is not a big move. Yes, you're going to see headline numbers, and you said it completely correctly, that it's because the prices are so high. We've come so far that a 500-point move in the Dow is not what a 500-point move was 6 months ago, or certainly 2 or 3 or 4 years ago. We have overcome every single crisis over the last 10 years. And I'm not going to go through the list, but I mean, it's been amazing. You know, the tsunami, we've had, you know, earthquakes, banks, you know, Greece, whatever, Brexit, impeachment. I mean, amazing things that the markets have overcome. And as it stands right now, you're seeing a flight to quality into treasuries, which is natural, and rates are going lower and lower and lower. So where's money going to go? Money's going to go into the stock market because that's where they can get yield. And if you look at what we've seen, we've got the 10-year note going down below. We're approaching those lows one more time of 1.5%. And there's about a 50% chance of a rate cut in July and about a 75% chance of a rate cut by December. So that policy is not going to change. You've got to remember that the people here in the U.S., the policymakers, I'm not saying the people, the policymakers are going to do everything and anything they can to support the stock market. So, you know, let's not forget where their interests lie.
So I think you're getting to an important part here, Alan. You mentioned the interest on the part of investors in the safety of bonds. And so we've seen what's been happening with the 10-year Treasury yield. We've also talked about, on a day like today, how investors gravitate towards safe havens like gold, which is now approaching, nearly $1,600 an ounce. So if I pull out the charts for the last year, I'm looking at a gold price going up. I'm looking at a 10-year yield that is going down. I'm looking at equities that have broadly been going up. In other words, you got a market here that seems to embrace both risk and safety.
Well, money's on the move. You got to remember that. And gold was dead in the water for the longest time. It had so many opportunities where it should have moved up and it never reacted positively. I think part of that is just money flow. And once you get to a lofty level in stocks, money moves to areas that haven't participated. And I think really that's what has happened there. We're in the middle of earnings season, and we're going to get a lot of numbers here this week. And it's going to show us how well corporate America is doing. And we continue to beat expectations time and time again. And that's really the game that the stock market plays. So to say that the stock market's over is premature. It's not something I'm certainly going to say. We're in day 2 of a pullback. Let's see where we go. And not to minimize what's happening, but we've been through this with Ebola. We went through this with SARS, and the markets have come back each and every time. Barring global catastrophe, which I can't predict, and I certainly wouldn't want to. Let's remember that 50,000 people a year die from the flu in America every single year. So I'm not minimizing what's happening, but we've got to talk about facts and impact and really what does it mean. And right now, this is just an unfortunate situation that the markets have focused on because we have moved straight up in stocks.
Yeah. Well, hey, it's a conversation we have to have, right? Whether we're having it on trading floors or in our living rooms with our families. Alan, great to get your perspective. Thanks as always, Alan Nuckman, Chief Market Strategist at Agora Financial.